Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the president of Financial Resources Group. They're out of Glastonbury. You can find them online at www.frplan.com. F as in Frank. frplan.com. I would start there. The phone number, this is where the rubber hits the road, my friends. 860-657-8380. Again, 860-657-8380. That's the number for you to call Mark and ask about obtaining your free Roth BluePrint. You're going to get up to 97% increase in wealth. We're talking, this is significant. No jumping tax brackets, no out-of-pocket, costs, and there's no decline in principal balance on conversion. So, Mark, maybe a little bit later on, you can fill us in on this. And you can't get this free anywhere. You just get that free with Mark Papa, and all you need to do is call that number, 860-657-8380, to get it. Mark, good morning. Great to see you.
Hey, good morning, Gary. And I'm glad you brought up the Roth BluePrint because I am going to be doing another event February 22nd at Ruth Chris Steakhouse, 6 p.m. on the Berlin Turnpike in Newington. It is an extremely popular event. It's so interesting. I started off, I overbooked the first one with 7,500 mailers. Then I only did 3,000 mailers the next time, and I was still overbooked. So we're having a great success, and people are very, very interested. So what we're saying, Gary, to folks is if with this Roth BluePrint software, it was designed by a guy by the name of Steve Hutchinson. I am one of the only people in the state of Connecticut that has this software. I'm going to make an offer to all the audience because not all of you can, make it to Ruth Chris on a Tuesday night. Mm-hmm. That anybody who's a listener of this show can call in at 860-657-8380 and learn how we can potentially get you up to 97% more wealth. Okay, you can convert your IRA without jumping tax brackets. There'll be no out-of-pocket costs, and we can do it in a way that you will not lose your principal balance. So let me repeat that. Up to 97% more wealth in your legacy retirement. You're not going to we can set it up so you don't jump tax brackets so that you have no out-of-pocket costs. And you're going to do it in a way that you do not lose your principal. So whatever value you start with in the worst case, you're going to end up with that same balance in the end, and you're not going to take that big hit up front. That's what discourages a lot of people that call their CPA who doesn't have this software and says, oh, you're just going to pay more in taxes, you're going to pay more in IRMA, you're going to pay more in this. And the reality is we show you a way to streamline that and optimize that Roth conversion. Now, there's one also big catch. The last time they extended the Trump tax cuts, that was done under reconciliation, Gary. That means they only needed a 51% majority. If we are adding $1 trillion in debt into our national debt every 3 months or so, 5 months, whatever it is, here's the bottom line. The next time around, we have a 6 to 7 year or 8 year window that you have to convert that Roth. Otherwise, what we see happening is with the massive amounts of debt out there, it's going to take a 2/3 vote the next time in order to extend those tax cuts. Which
and that's not going to happen, right?
I don't see it happening. So not with such a divided Congress. So for the people who want to act today and at least get the ball rolling, at least take a look at this thing, let's take a look at the Roth BluePrint and let me show you how we can, again, potentially massively increase your wealth and have a lot more tax-free income and a better legacy for your children.
And like you said, no jumping tax brackets. Before I get into the show, on the heels of this free Roth BluePrint, you're the only one really that's offering this. There's no other financial advisor. Well,
there's one other guy I was at the conference with who is in the New Haven market. I just don't know if he's on the radio. And I think he's doing dinner seminars in like the New Haven, North Haven area. Super nice guy. So, but I don't even, But
again, generally speaking, in the Hartford area,
there's 3 million people in the state. So good luck. I'm the needle in the haystack, but I'm the one with the goods.
No one else is really governing this free.
You can't get this at any major firm. You're not going to get it online. You're not going to find the calculator on the Vanguards. You're not going to find something this comprehensive. Not at all. And especially as it relates to IRMA, Social Security taxes. The widow's penalty when someone passes, their spouse jumps in tax brackets, none of that. They don't have that software.
Awesome.
This is the only game in town. So And if anyone is interested in having a better, a more tax-efficient retirement, that's why you need to call me at 860-657-8380 and get on my calendar.
All right. Let's dive into the wild world of the stock market. And we've got some turbulence in tech stocks and a surprising shine on dividend payers, Mark. I find this fascinating. So let's start with this. Let me just get your take on this past week's action.
Okay, for sure. And let me just start with my brief disclaimer that this is not an offer to buy or sell securities, and the opinions reflected on this show are for educational purpose only. They should not be construed as investment advice, and please consult a financial professional before acting on any information you hear on this show, or more importantly, just give me a call. Okay, so let's jump right into it. Tech stocks have been selling off. They've been taking a hit. They're under some pressure, and a lot of this has to do with if you go back to 2023. I feel that we should have actually had a market that would have been recessionary in nature, but we had Biden passed that giant bill, the Inflation Reduction Act, which I think was just another stimulus. But the other side of it was the AI stocks, artificial intelligence. As we started hearing about Sam Altman and ChatGPT and Microsoft and NVIDIA are spending massive amounts of money. So what's happened is this trade is finally coming to fruition. It's finally long in the tooth. And smart investors are actually looking for ways to diversify in other areas. And there's a growing doubt about the long-term payoff from these massive AI investments. So there was a great article in, I think it was the Financial Times of London, talking about how Microsoft, Oracle, Facebook, these used to technically be either social media or software companies. Now they're essentially becoming infrastructure plays, investing in these giant data centers. They've also borrowed a lot of money to build out these data centers. And what's interesting is a lot of that debt is off balance sheet. It doesn't even show up on their books, which is a really clever, really interesting. So there's a lot of, but now, they're under constraints to build and spend these data centers, but someone's going to have to maintain them. So their business model have changed from software companies to essentially trying to become utilities to control all the computing power. Excuse me. Now there's also other competitions creeping into the market. Recent updates to tools like from Anthropic are ramping up the competition in data analytics, professional services, and software. And we're seeing pressure on the big names like NVIDIA, which dropped last week, as well as Microsoft and Oracle. So we're seeing, there's been a lot of pressure there. And so it's not just the AI hype cooling. I think what's happening is people want to see the money. It's a show me the money trade finally. It's not just about the hype of the future.
Well, it wasn't just isolated to tech giants neither. I mean, was there broader market stuff at play here?
Yeah, there was. I mean, we're looking at partially, we just nominated a new Fed chair, Kevin Warsh.
Yeah.
I'm sure you've been talking a lot about that in your show. And what's interesting is he was the hawkish choice. Essentially, he's hawkish for stroking fears of tighter monetary policy in the past. But we've had rising bond yields and tighter financial conditions are leading to de-risking, especially in these crowded tech positions, the Mag 7, which I've been talking about, Gary.
Yep.
We've been diversifying away from the Mag 7. Everyone's like, I own NVIDIA, I own Microsoft and Facebook and Amazon, and everyone's doing very well with this Mag 7 trade. That's long in the tooth. It's tired. It was a trade from, let's say, 2023 to 2025. And what we're starting to see is just a new forms of leadership in the market starting to show up. People are starting to become more defensive, and you need to be. That's why we diversify our portfolios, Gary. I've talked about that over and over again. It isn't just about, the earnings, but it's about the fundamentals, and it's more about liquidity concerns and overextended valuations of these companies. So, one other example would be PayPal dropped 20% on weak guidance, and a CEO change at Disney with Bob Iger. They beat earnings, but look what happened to the stock. It tanked. So it's a market is priced to perfection right now.
And the broader indices felt, I think it felt it too, right? S&P was down 0.8. Dow was off 0.3. So is this a full-blown rotation, or is this just a little blip?
I would say it's more of a blip. I think the long-term trend is still very favorable. The fundamentals are very favorable, but you have to take a look at reality here, and eventually reality sets in. Nothing goes up forever, Gary, and that's, I think, the lesson that people need to learn. Just going back to Warsh, and you can blame Warsh or not blame Warsh for. We saw, maybe I talked about the Hunt brothers, and
you did.
Silver crashing 50%. Imagine that. And remember, I talked about how the CME, which is the Chicago Mercantile Exchange, back then increased the margin requirement and blew up the trade on the Hunt brothers. That's exactly what happened. And what I say to everybody is markets worked. The safeguards and the guardrails that they put in worked. Silver was just and gold and silver, by the way, are still up 15% for the year. So, but we have to take a look at the big picture here. Those people who were trading on leveraged silver, leveraged gold miners, junior miners. Remember I talked about getting your face ripped off, Gary? Well, some of those people who are trading on leverage definitely got their face ripped off. And that's a quote from one of my favorite books ever written called Liar's Poker. By Michael Lewis. It's one of the best reads that you're ever going to read if it's an old book, but it's timeless. But yeah, you don't want to get your face ripped off, so you have to be so careful. But that's what happened. What happened. It actually, gold and silver sold off 30%.
I want to shift.
It's starting to bounce back, but it sold off.
I want to shift gears just a little bit. It's interesting you bring up silver and gold. I do want to get to that in a moment. But dividend stocks, they're outperforming so far here in 2026. Why? What's driving that trend amid all this volatility?
Well, it's a classic rotation, Gary, after years of that AI dominance, making tech look a bit frothy, and investors are turning to undervalued companies. These are the companies that have been left behind in the S&P for like 5-6 years. And they were good, solid companies, but everyone's chasing the AI trade. So eventually what happens is the market's going to say, well, where do I get value if everything is overvalued? And that's exactly what's happening. So areas like materials, and we're looking at materials. I think just this week, the Prime Minister of Italy was talking to the United States about more materials because they're a big industrial player as well. In locking down and securing all the materials and the rare earths, because a lot of it comes from China, most of it does, and we're trying to secure other resources for us. So materials have been very strong. Industrials and consumer defensive companies, again, which were dead money, for for a long time, are starting to bounce back. And then energy, which has been a very good good performance going in the past, but because of the amount of power it's going to take natural gas, it's going to take oil, it's going to take everything to power these data centers, nuclear, and then look, for certain areas, there is wind and solar. So you want to own a diversified global energy fund. You don't just want to have oil or gas or bet in any one direction. You want to have something that's highly diversified in the space, because we're going to need so much power to fund these data centers, Gary. It's such an extreme amount of money. There's no way that any one source is going to be able to handle it.
Yeah, no, I agree.
And even the Saudis are smart, are starting to. I don't know if you know this. There's a guy called Doomberg.
Well,
he writes a Substack, a great blog about how the Saudis, because they have so much oil, a lot of their actual power plants are powered by oil, whereas we use natural gas. And they're starting to smarten up, and they're starting to tap into their gas reserves overseas in Saudi Arabia and in the Middle East. So they're going to start building more cleaner power plants as well. So it's pretty interesting what's going on.
Rates, though, they've been coming down. Does that play into why dividends are attractive again?
Yes, it does, because it makes bonds less attractive.
Oh, wow.
So bonds become more risky. And then, if the reward for owning those bonds are no longer that attractive anymore, people will shift over to higher performing equities or dividend stocks. And dividend stocks have had a nice run. If you look at the dividend aristocrats or some of these other dividend ETFs or stock sleeves, they're starting to see much better performance. And again, if you have that, not just growth, like everyone's chasing the growth trade, but you split your portfolio down the middle, because you never know when value is going to take off. When we build our portfolios, Gary, we have our growth, but we also make sure we have our value as well. And the value is those stodgier, older, high cash flowing companies. They may not trade at nosebleed price to multiples, but they are there. They're high-quality companies that are there to weather the storm. When markets are down. And we know, just like what Warren Buffett, when he buys a good company that has great management, good balance sheets, increasing dividends, increasing earnings over very long periods of time, we're gonna do better than those people who are just trying to chase the hottest stocks or the hottest sector of the market. You can't. No one can do that successfully. And
let's face it, we're in an uncertain environment right now, post-election policies and all. So why focus on dividends for stability? Well,
because it's lower yields on your savings accounts make dividends a lot more attractive. So we're not making 5% on our accounts anymore. What used to be, money markets that were making 4 or 5% are now making 3.5%, 3.75%. So people are like, well, after inflation, what am I really making? I'm making nothing. After inflation and taxes, if you're in a CD, you're making nothing, really. How much are you making? So, yeah, having dividend stocks, which gives you, some upside, and at the same time you have some income and then some tax-preferred income too, because dividends aren't just ordinary income like interest. You get qualified dividends, which are either 0, 15, or 20%. So you can actually do a little better with dividends. They're more tax favorable. And then there's a lot of companies also as well. Not only are they growing their earnings, becoming more efficient, I think using artificial intelligence, whether it's in their supply chains or their day-to-day operations, but they're going to take that free cash flow and those increasing profits and either increase their dividends or buy back stock. By buying back stock, that lowers the amount of shares outstanding and boosts the stock price. So we're going to see, I think that's a trend that's going to definitely be around for a while.
Folks, you are listening to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the president of Financial Resources Group right here out of Glastonbury, Connecticut. You can find him online at FRPlan. That's FRPlan.com. Also, 860-657-8380. 860-657-8380. This is the number. This is the website. He is the person. Financial Resources Group is the company for your free Roth BluePrint. There's no one who is offering this to you free, and you are getting it absolutely free. People pay money. There are advisors who aren't even offering this at all, let alone for free. But you're going to get yours for free at 860-657-8380. More towards the end of the show, I'll have Mark give a little synopsis of what that entails and give you those points of contact again. There's this recent buzz. You mentioned his name just a moment ago. Yeah, we have been talking about him a lot. More like the early part of next week. Of course, I'm talking about Kevin Warsh as our next Fed Reserve Chair. And look, I figured this question would just be better for you. This is your area, not mine. But a lot of listeners were calling in wondering, what this actually means for Fed policy. So, Mark, could you answer that question?
Well, I think one of the big things that happens is when you change Fed chairs, and I was just listening this week, I didn't know who it was, but it was actually a pretty smart statement. Whenever you change a Federal Reserve chair, you're going to have policy changes. You're going to have a different direction. You're going to have different ways of interpreting. I remember going back to my early days when it was Alan Greenspan, and
in the 80s and 90s,
yeah, and everyone would look at Greenspan actually got hired right before the 87 crash. What was interesting though with him is that they used to look at his briefcase, and they were trying to predict if I can't remember what it was, but if he had his briefcase in his left hand, they were going to cut rates or something silly like that. Like there's all these Fed watchers.
I didn't know.
And today we have much different. I think a little bit more transparent Federal Reserve. But, a lot of people will say Powell was late to the party. He was late to, he raised rates too soon. He cut rates, he raised rates too soon in the beginning of his career. Then he cut rates too much and then let them stay low for too long. And then he waited too long to actually increase rates again to fight inflation. So Kevin Warsh is, I think, a great pick. He's I'm happy.
I was going to ask you
that Trump picked him. I think what he's going to do is set the tone of the Federal Reserve to focus on one thing: monetary policy.
What's his background, by the way?
Well, he was a former Fed. He was on the Federal Reserve.
Back a while ago. I think W. Bush W. put him on, right?
Yeah, he was on the Fed board from 2006 to 2011 and during the financial crisis. So back then he was seen as a hawk. So that's kind of what scared the market. is the market's living on forward expectations of additional rate cuts. And he was reluctant to cut rates aggressively due to inflation worries, and he was opposed to expansive tools like quantitative easing. So he's definitely more traditional in the sense of more traditionally conservative than a lot of the more dovish, prospects and more dovish Federal Reserve governors. But he's also concerned about the ballooning Federal Reserve balance sheet, which stands at about $6.59 trillion. And I'm not sure if you saw that recent interview. I think it was the head of the World Bank, don't quote me 100%, saying that the Federal Reserve owning all these different assets is acting like a hedge fund, and that's not the job of the Federal Reserve. So he's consistently pushed for shrinking the materially shrinking, the balance sheet to pre-2008 norms, because otherwise we're just acting like another banana republic. And this could lead to higher long-term Treasury yields and a steeper yield curve. So, yeah, that is a concern. However, we need to get back to basics, get back to fundamentals. And I think that's what he's going to do. And I think that's why President Trump picked him.
I mean, he's shifted, though. I also heard that. He's right. He's more in line with Trump's call for lower rates. So are you saying he's not that hawk anymore? Do I have that correct?
I think he's a good balance between all the different candidates. I don't think you could put a label on this on Warsh at all. I think he's somebody who's going to look at what needs to be done and get it done and do the job right. And he has leaned dovish, and he's argued in op-eds about the Fed being, too slow on rate cuts and blaming them for persistent inflation, and also saying productivity boosts from AI could also allow easing without spiking prices. And that's an argument a lot of people make. We can still have strong growth with low inflation if we play our cards right. So he's in that camp as well. And he also said he could revert to hawkish instincts from long term. When you're the Fed chair, you don't want to be predictable. You want to do what's right, and and that's exactly what I think he's going to do. So he's my favorite of all the picks.
All right. There was another Kevin I know that was in the mix there. And let's face it, the markets reacted strongly. Tech sell-off, it was rising yields. And you think, is this nomination, is it stoking fears about Fed independence?
Well, I think there's a concern. I think they're way overblown. I think just a shift in sentiment. I think it was something needed to happen in order to, get this Mag 7 trade to eventually sell off and get the market more balanced. We just had an extremely unbalanced, extremely top-heavy market. 7 companies have dominated the indexes, and it's great to see that where people are spreading out their bets and investing in other areas. I don't know if, no, you're never going to convince a Democrat that the Fed is not going to remain independent because Trump's president, that Trump's going to, put a puppet in there and control him. But he doesn't seem like that guy. I don't think this is one of those people that the president is going to be able to manipulate, at least not as much as some of the others.
We're running out of time, and I really want to kind of zoom in on something that's been making a lot of headlines. The so-called debasement trade. How does Warsh factor into that? And what's going on with gold and silver right now, by the way? I've only got about 3 minutes, so.
Okay. Well, that's a great question. Essentially what's happened, the debasement trade is obviously the devaluation of the dollar and currencies. And what we're seeing is, I would say it's a more normalization of the dollar. It's getting weak. I put up a chart of the dollar. The dollar is not stood at a historic low by any measure. In fact, it's somewhere middle range. And I think what's happening is, we do have a lot of debt. And but that's what caused speculative bubbles in gold and silver. I think the long term for gold and silver, the fundamentals still remain intact. I just don't think that silver should be trading at 120 as quickly as it was, up. But I still think the long term trend is up.
The paper is 120. The actual
right.
The paper is at 85 or 90.
Yeah. Well, let's remember that there's not enough of silver out there to back all the contracts available. So if people wanted delivery, they'd be waiting in line because there's so many derivatives being written on silver. So that was one of the other reasons that we saw a bubble pop. And I think that's a healthy thing for the market, though. You don't want things just to go parabolically up all the time. So investors pile in, and they fear that the dollar's value will erode over time. And I think Warsh's nomination as Fed chair is a wrench in that narrative ultimately. And I think he wants to shrink the balance sheet. I think he wants to keep the dollar more stable, and he sees less money printing and more discipline, reducing the debasement fears. And that's led to this massive unwind. So,
what's turning the tide here?
Well, I think it's flat out. It's just sentiment. We have new leadership, and again, going back to that other interview I listened to. The markets tend to sell off when we switch Fed chairs, just because there's just a change in policy or just a change in direction. But I think the underlying fundamentals of the economy are very strong. Oh, and I'm going to talk about tax cuts next week, Gary. The tax cuts. I'm going to have a big. We're going to talk about tax cuts and some of the things I'm seeing and that I think are going to really, really help the economy, like taxes, like not taxing overtime and not taxing wages and tips. Not taxing tips, I think is going to have a huge impact for the consumer.
Except here in Connecticut.
Yeah, well, Connecticut, the state won't allow the deduction, but you'll still get the federal.
Yeah, and let's talk crypto next week too. I think
we're going to definitely hit on crypto.
Can you bring your buddy Manny back in?
Yeah, Manny's actually confirmed that he'll be here.
Great, I can't wait for it.
So
I got to wrap things up. I want to take a little extra time in wrapping things up because I want you to explain, and I don't have a lot of time right now, but give a brief synopsis about this Roth BluePrint that people can get free, and now really they can only get it through you.
Exactly. So I have a license for the software. It's the Roth BluePrint. It's extremely comprehensive, very detailed. We get a copy of your tax return. We look at your modified and your adjusted gross income. We look at your Social Security. We look at all, everything. And then what we'll do is we'll look at the size of your IRA. We'll look at your tax bracket, and we go in and we figure out a way to optimize that Roth conversion. Here's the bottom line. If you don't do the Roth conversion because you're afraid of the taxes, we have a way for you to pay the taxes from within the Roth IRA. Ooh. We have a way to make sure that you do it at no out-of-pocket cost. We make sure you can do it without jumping tax brackets if whatever you're comfortable with. We can also show you a way to do it without losing principal balance.
That's key.
But I am going to show you the way that if you don't do it, it's going to cost you a lot more money to sit in that IRA than if you don't do the conversion.
Then this is a no-brainer because you're offering this for free.
It's a huge no-brainer. And don't listen to your CPA on this. They don't have the software. And most of them haven't been trained, and most of them are dinosaurs.
You want it for free? Call right now, 860-657-8380. Again, it's 860-657-8380 and online at frplan.com. For Mark Papa, president of Financial Resources Group in Glastonbury, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.